Wall Street has a secret language that most Americans never fully understand. We hear about stocks rising, bonds falling, or the Dow Jones making headlines, but the meaning feels hidden. This mystery often keeps everyday people away from building wealth through investing. The truth is, once you decode this language, you'll see money opportunities all around you. Today, on the Finance Decoder, we're breaking down Wall Street's secret language of stocks, bonds, and indices in the simplest way possible. Stocks are simply ownership shares in a company that let you benefit when the company grows. If Apple makes more iPhones and earns more profit, Apple stockholders share in that success. When you buy one share, you literally own a small piece of that company. That piece may be tiny, but multiplied over time, it can build incredible wealth. This is why Warren Buffett always says that owning stocks is owning businesses, not just paper. Bonds, on the other hand, are like loans you give to a company or the government. When you buy a bond, you're basically saying, "Here's my money, pay me back with interest." They are generally considered safer than stocks, but they usually grow wealth more slowly. Think of bonds as steady rent checks, while stocks are like running a business that can grow fast. That's why retirees often prefer bonds for stability, while young investors lean toward stocks for growth. Now let's talk about indices like the Dow Jones, S&P 500, and NASDAQ. An index is simply a collection of stocks grouped together to show how a part of the market is doing. For example, the S&P 500 includes 500 of America's biggest companies across all industries. If that index rises, it means the overall market is doing well. If it falls, investors are nervous. That's why indices are often called the scoreboards of Wall Street. Most beginners don't realize that investing in an index is like buying the whole market at once. Instead of betting on one company, you spread your money across hundreds of companies. This reduces your risk because even if one company struggles, others in the index can rise. It's like owning a giant basket of eggs instead of putting all your eggs in one basket. That's why index funds are considered one of the smartest ways for ordinary Americans to invest. Another secret of Wall Street is compounding, which Albert Einstein once called the eighth wonder of the world. Compounding means your money earns returns, and then those returns start earning returns too. Over years, this snowball effect can turn small investments into huge fortunes. For example, $10,000 invested in the S&P 500 30 years ago would now be worth over $200,000. That's the hidden magic of letting your money work for you instead of sitting idle. One big mistake new investors make is chasing quick money by day trading. They see flashy TikToks or YouTube videos of traders making thousands in minutes. But what they don't see are the millions lost by those same traders over time. Day trading is like gambling in Las Vegas. Fun for a night, but dangerous as a lifestyle. That's why most financial mentors recommend long-term investing instead of chasing quick wins. Long-term investing gives your money time to grow and recover from market crashes. Every decade, the stock market has ups and downs, but historically, it always rises higher. People who panic sell during a crash often lock in their losses forever. But those who stay patient usually come out wealthier when the market recovers. Patience in investing isn't just a skill, it's the greatest financial superpower you can have. Fear and greed are the two emotions that control most investors on Wall Street. Fear makes people sell too early, while greed pushes them to buy at the wrong time. The market often tricks emotional investors into losing money this way. Smart investors learn to control emotions and stick to a disciplined plan. Discipline, not emotion, is the real engine of long-term financial success. Another common mistake is ignoring risk management. Some people put all their money in one hot stock or crypto coin. When that bet fails, their entire financial dream collapses. Risk management means spreading your investments so no single loss can destroy you. Think of it as wearing a financial seatbelt every time you invest. Diversification is one of the golden rules of investing. It means spreading your money across different assets like stocks, bonds, and real estate. This way, when one investment struggles, another can balance it out. Think of it like building a team. You don't want just one superstar, you need balance. That's why every successful investor builds a portfolio, not just a single bet. A powerful example of diversification comes from the 2008 financial crisis. When real estate collapsed, many people lost everything because all their wealth was tied to housing. But investors who also held stocks, bonds, or even gold were able to survive the downturn. Their diversified portfolios acted like lifeboats during a financial storm. This is why spreading your money is not optional, it's survival. Another mistake new investors make is chasing hot stocks without research. They hear about a company on the news or from a friend and rush to buy it. Often, by the time the hype reaches the public, the real profits are already gone. This leads to disappointment when the stock falls right after they buy. Smart investors know that research and patience matter more than hype. Warren Buffett himself avoids hype-driven stocks and sticks to businesses he understands. He once said he would never invest in a company he can't explain in simple words. That philosophy kept him away from many tech bubbles that later crashed. Instead, he focused on stable companies with long-term growth like Coca-Cola and American Express. His discipline shows that simple principles often beat complicated strategies. Risk management is the backbone of smart investing. It's not about avoiding risk completely, but about controlling how much you take. For example, putting all your savings into one stock is extremely risky. But spreading that money across 20 different companies reduces your exposure. This is how professional investors survive market ups and downs without losing sleep. Emotions are another major risk in investing. Fear and greed drive most market crashes and bubbles. When prices fall, fear makes people sell at the worst possible time. When prices rise too fast, greed tempts people to jump in too late. The investor who controls emotions often outperforms the one chasing feelings. Compounding is another secret weapon of long-term investors. It's the process where your money earns returns, and then those returns start earning too. Think of it like a snowball rolling down a hill, growing bigger with every turn. The earlier you start investing, the more powerful compounding becomes. That's why financial advisors always say, time in the market beats timing the market. Patience is the partner of compounding. If you pull your money out too early, you break the cycle of growth. Many investors lose potential wealth because they can't wait long enough. The stock market rewards those who stay invested during both good and bad times. History shows that even after crashes, markets recover and climb higher over decades. Indices like the S&P 500 are powerful tools for patient investors. They represent a collection of the top companies in the U.S. economy. By owning an index fund, you own a slice of all those businesses at once. This gives you instant diversification without needing to pick individual stocks. It's like buying the entire American economy in a single investment. The Dow Jones Industrial Average is another famous index. It tracks 30 large U.S. companies that represent key industries. When you hear the news say, the Dow is up, it's these companies moving together. Though smaller than the S&P 500, it remains a symbol of American financial health. Watching these indices is like checking the pulse of the entire market. Bonds are another key part of Wall Street's language. They are essentially loans you give to governments or corporations. In return, they promise to pay you back with interest over time. Bonds are usually less risky than stocks, but also offer lower returns. They act as a safety net in a portfolio, especially during market turbulence. A balanced portfolio often mixes stocks for growth and bonds for stability. This combination allows you to capture upside while reducing risk. Young investors may lean more on stocks because they have time to recover. Older investors usually increase their bond holdings to protect wealth. The right balance depends on your goals, age, and risk tolerance. Discipline is the most underrated part of financial success. Markets will rise and fall, but your patience must stay firm. Those who chase quick profits usually end up with big losses. True wealth builders stick to their plan even when it's boring. Consistency, not excitement, is what wins in the long run. Wall Street's language may seem complicated, but it all boils down to discipline and clarity. Stocks represent ownership, bonds represent lending, and indices represent measurement. Mix them wisely, and you can build a portfolio that survives any storm. The key is not predicting the future, but preparing for it. Once you learn this language, you control your money instead of money controlling you. The biggest secret is that wealth is not built in days, but in decades. Every paycheck, every savings choice, and every investment adds up. Compounding turns small steps into life-changing results over time. It's not about luck on Wall Street, but discipline on Main Street. The sooner you start, the greater your financial freedom will be. So remember, Wall Street's language is not meant to confuse you, but to guide you. Stocks, bonds, and indices are tools. How you use them is what matters. Stay disciplined, stay patient, and let compounding be your silent partner. Money is powerful, but it should work for you, not the other way around. This is the real finance decoder, and now you hold the key. If this video helped you decode Wall Street's secret language, don't keep it to yourself. Hit that like button, share it with friends, and subscribe to the Finance Decoder. Every week, we unlock another layer of financial wisdom you can actually use. Next time, we'll uncover the truth about credit scores and how they silently control your life. Stay tuned, stay disciplined, and remember, the power of money is in your hands.